Whether you are an individual or a business, if you are looking to invest in any venture or equity markets or any debt instruments, here are 3 points that you should know which are very critical in decision making. Hi, I am Yashwan Nijgal, a chartered accountant in practice. So let me start off with an example. Recently, one of my client had sold one of his properties and there was a capital gain to the tune of rupees 1 crore, and this client was evaluating investing in government bonds in order to save capital gain taxes. Now let us break this down into different aspects to understand the example better. So had the client invested rupees 1 crore in the government bonds, the capital gain taxes that he would have saved would be rupees 25 lakh rupees, and the return on such bonds from the government would have been 5% per annum. That would have resulted in 25 lakhs over a period of 5 years. And for the sake of calculation, I am ignoring net present value. So the net saving from this particular investment would have been 25 lakhs from the capital gain taxes saved and 25 lakhs from the interest received on these bonds, totaling to 50 lakh rupees. So at the end of 5 years, he would have ended up with 1.25 crores as the bank balance. Now the second option would be to pay off this capital gain taxes of rupees 25 lakhs and invest the remainder of the 75 lakhs in any equity or mutual fund instruments, and considering the current market conditions, an IRR of 15% is definitely not optimistic. So with 15% as IRR, the client would have earned 1.5 crores, which is 25 lakhs more than option number 1. This is to say that your investment decisions should not be based on your short-term savings or short-term gains. So how do we go about deciding on where to invest and how to invest? Here are 3 points that you should know before taking any decisions on investments. So the first metric would be payback period. This would tell you how long it would take for you to get back the money that you have initially invested. You can calculate this by simply dividing the total amount invested by the annualized income that you would get from the investment made. The second metric would be something called as IRR, or internal rate of return. This basically is a percentage of annualized return which will be calculated based on the cash flows that you would be receiving over a period of time from the investment made. So if you have the cash flows or projected cash flows with you, you can calculate the IRR simply by using any tool on the internet. The third metric is called as cash on cash return. This is important for investors who are keen on having annualized return from the investments that they make. You can calculate this by dividing the annual cash flows with the total investment that you have made initially. So higher the cash on cash ratio, more would be the liquidity available to the investor. To conclude, I would say that there are n number of metrics which are available for any investor to decide on the investment decisions. However, a combination of the 3 metrics that we have discussed in this video would give a clear picture on 3 important aspects. One is the actual profitability from the investment. The second one is the period of return from the investment. And the third one is the liquidity position for the investor from such investments.